Is this on? All right. Hey, everyone. My name's MacLeod, founder of SurePath Capital Partners. Really happy to be here. I feel like at this point in the day, we should all have beers. So I'll try and keep this short so we can have beers. You can't tell from my accent, but I actually lived in Scotland until I was 11. So it's a real pleasure to be back on this side of the Atlantic. Today, we're going to talk about achieving meaningful exits for SaaS companies. Has anyone here ever gone through an exit before? No one? Would anyone like to have an exit? All right, hopefully, okay. If any of you don't want to have an exit, you can go. All right, so what we're going to do is, I guess, a couple of things. I'll just give a brief intro. I'm going to show you some data of actual exit activity in Europe for the last couple of years, and then talk about some takeaways about how you can achieve a meaningful exit for your own business. Very brief commercial. So I've been in the venture-backed software space for almost 2 decades. I spent 14 years as CFO for a number of SaaS startups, including FreshBooks and Shopify. Also spent 3 years on the dark side as a VC, investing primarily in SaaS for SMB. I now run SurePath Capital Partners. You could think of us as like a non-sketchy investment bank, which is actually a pretty rare thing. We help companies raise growth capital, and we help them think through intentional, profitable exit strategies. I really think that to be the best possible advisor to our clients and have the best knowledge and the best networks, we must be specialized. And so most, but not all of our clients are SaaS companies that serve the global SMB software market. And because I come from that space as an operator and an investor, I've been able to build very close relationships with the most active buyers, like the Intuits and the Sages and Squares of the world. So I think that's it for the commercial. Let's talk about European SaaS exit activity. So I don't know if you can see this, but this is kind of SaaS exits over the last couple of years, kind of by type. So the black bar are acquisitions, and the red bar, if you can see it, are IPOs. Generally speaking, what I see over in North America is about 5% of the exits happen by way of IPO. The other 95% are acquisitions. And what I was surprised to see when I looked at the European data is it was much more heavily skewed towards acquisitions. And even these IPOs, like the most recent one was LoopUp, who went public in August. And that went public on the AIM exchange, which is a junior exchange. And so what I've seen here is more modest IPOs and far more acquisitions. If we look at kind of where the buyers come from, some interesting takeaways here. As you would expect, the vast majority of buyers of European SaaS companies are, European buyers, but over 40% were North American buyers. And I was listening to a talk on the other stage earlier, where the advice was basically you need to win the U.S. market in order to kind of win globally, and obviously, the biggest buyers are in the U.S., and I think you're seeing that in this data here. So a meaningful number of buyers of European SaaS companies are American buyers. And then I looked at buyers by type, publicly traded companies versus private companies. And again, I was quite surprised by the data. Most of the exits in the last couple of years were private companies buying other private companies. Now, in this era of companies, postponing indefinitely going public and raising seemingly infinite amounts of venture capital, think Uber as an example, then yeah, it makes sense. You could actually achieve a pretty meaningful exit selling to a privately held company. But generally speaking, when you start your own company and you have these totally illiquid shares and it's totally risky, and then you trade that for someone else's totally illiquid and risky stock, generally that happens with more modest outcomes. And so when you drill into the data here, and I'll touch on that in a moment, unfortunately a number of those private-to-private deals are quite small. So who are some of the buyers? There's a very large number of buyers, but this is just a few of them. J2 Global, which is an American company, and Alphabet, parent company of Google, are among the most active buyers in the last couple of years. A few other names here. I'm from Canada. Pleased to see Lightspeed, which is a Montreal company, has been active buying over here. So just a few names, but there are literally hundreds of buyers who have been active here over the last 2 years. Exits by age. So some interesting data here. I think, the punchline when you think about how long it takes you to go from the start of your company to the exit is that good things just sometimes take time. And so, a full half of the exits happen kind of inside 10 years. But, if you read TechCrunch too much, if there's any TechCrunch reporters here, no disrespect, you think that you go from nothing to a $100 million outcome in 3 years, and that's just not the reality. And so you see that here in the data. There's a meaningful number of companies that are almost 3 decades old. They're longer than SaaS has been around, and so they've gone through kind of several life cycles. Exits by size. So once again, I'm going to slam TechCrunch, right? All you hear about is that, these great big outcomes, but unfortunately, most outcomes are actually quite modest. And so the vast majority of exits have either no disclosed value or a value that is sub $50 million. And I should point out, all of our data here is in US dollars, because that's just the way our database works. And sometimes those deals that have no disclosed value are actually quite large, and it just reflects the fact that the buyer is so unbelievably large that your company is immaterial to them, so they don't disclose the value. But unfortunately, more often than not, it means that the acquisitions are quite modest. And so in the last 2 years, there have only been 3 acquisitions that are north of $200 million in Europe, in SaaS. And so if you think of that, if there's any VCs in the room, then they would know this. If you own 10% of a company that exits for $200 million, so you're going to take $20 million back, but you have a $100 million fund, it's kind of irrelevant. You need so many of those exits in order to kind of make the VC math work. And so, the venture side really relies on those kind of massive outlier outcomes. And this is only over a 2-year period, but I was hoping to see more of those kind of bigger deals. Is anyone depressed yet? Sorry. I should start talking about nicer stuff. Funding status. This was really interesting. So I don't know if you can see the pie chart. I just realized I've probably been in the way for a bunch of folks. So if you look at kind of the distribution of companies that got to exit and what was their funding path, how many of them raised venture capital or private equity or were bootstrapped, actually more of the companies in the last 2 years got to exit without raising a penny. Which was quite interesting, and this is actually more heavily skewed towards bootstrapped companies in Europe than I see in the data in North America. I don't know if that reflects an absence of capital here. I don't think that's the case. There's certainly less, but there's plenty of local venture funds. I don't know if it's just a disposition towards not wanting to raise capital, because everyone's heard all the horror stories about VCs, which of course are all true. In the SMB market where we focus, there's a dynamic there where many of the markets in SMB are kind of evergreen. There's 3 million new businesses that get started in the US alone every year, and every one of those new businesses needs accounting software, project management software, email marketing. There's certain categories that are just evergreen. And so that's definitely a factor in some of this data here, right? There's certain categories of products where you don't have to raise money and you don't have to go for a massive home run from day one. But I was interested to see this data. And then, it should be no surprise, but if you raise money, the trade-off is you're giving away a portion of your company, but you're shooting for a higher outcome. And so, the companies that did raise capital did achieve a higher median exit than the bootstrapped ones. Unfortunately, in this data period over 2 years, the median venture-backed exit was smaller than the median bootstrapped exit. And that is not why you raise VC, and it's not why VCs raise funds. So this is anomalous data. You shouldn't usually see that. And the multiples, the valuation multiples, is like a function of kind of price divided by revenue. As you would expect, the funded companies have a higher multiple, and that's really, at the end of the day, stock markets, public and private, chase growth kind of above all else. And if you've raised a bunch of funny money, then theoretically you can invest it to grow faster than you could if you were bootstrapped, and that's why you see the bootstrap multiples are quite modest. So how do you achieve your exit? Who's ever heard this adage? Companies are bought, not sold. Anyone ever heard that before? I think it's true, except for, in my experience, nothing worthwhile ever just happens. Executives don't just show up. Products don't just get built. There's a whole bunch of things that you have to do in order to get that buyer to express an interest. So, there's no question that the outcomes tend to be bigger when buyers come inbound. If I think about the best exits that I've been through as an operator and a VC and an advisor, 100% of the time there's a higher multiple, a faster time to close, and you have more leverage if the buyers are coming into you versus you going out to them. But there's so much that you can do to kind of set the stage and create the conditions and create the relationships under which those buyers will come in. Which brings up the second point. Anytime I give a talk, I try and find a reason to put in a Glengarry Glen Ross slide because I just love the movie. So here we go, we've got it. Always be closing. And it's just a sales process. Everything is a sales process. And again, that's true whether you're hiring executives, winning customers, creating partnerships. And, in terms of building relationships, and this is especially true, I think, more so for business to business than business to consumer startups. If it's business to consumer, you just try and find some viral loop and you grow like crazy, and hopefully someone will get scared enough that they come around and buy you. But in a business to business context, your partnerships, your integrations really are key. And there's lots that you can be doing to create relationships. For instance, Salesforce, massive partner ecosystem. You don't want to just show up on their partner page and log in and try and win customers. You got to figure out how things truly work inside Salesforce and how you can get on the radar screen of the executives that can make things matter and drive distribution for you. So lots of things that you can be doing proactively to, like I say, create the conditions under which buyers are gonna want to buy you. Number 3, I don't know if you can see this, but in all of life, timing is important. And if I think of all the outcomes that I've been through, luck and timing have been 50% of the equation. And so this is from a blog post on SaaStr talking about, I guess, like the optimal time to exit your startup. And what you'll see is you kind of raise some initial funding, you've got all kinds of momentum, you hit about $1 million ARR. Usually at that point you raise a follow-on round of capital, at which point you're now too expensive for someone to buy until you deploy that capital and get to another milestone. In this case, it's usually about 10 million of ARR, at which point you've raised a Series B, pretty meaningful amount of capital. And there, once you've decided, I'll take a step back. I never want to discourage anyone from building big companies, quite the opposite. But I think the decision to raise a Series B, to raise a growth round, is a real fork in the road for founders and management teams. If you decide to raise that round, then you've committed to build a market leader. You've committed to shoot for a statistically improbable outcome. If you remember that slide a few slides ago about exits by size, most of them are quite modest. So if you raise that $10, $20 million growth round, now you're priced out of where the vast majority of exits happen. And so once again, you'll see once you raise you hit 10 million in ARR, presumably you've raised a Series B. Once again, not really the optimal time to exit. You have to deploy that capital and hunker down for a bunch of years and get to either an outlier acquisition outcome or get to an IPO, which if you remember from earlier, pretty rare. So that's just a thing on timing. Exit rule number 4. You know, what I've discovered over the years going through exits is that literally anything is possible. You can negotiate anything, especially if you have leverage. Back in my CFO days, I was CFO of a scalable storage software company, and we had inbound buyer interest, and we're in the middle of trying to close a Series B. The term sheet was signed, we were doing legal documents, we had even picked where the closing dinner was going to be. And because we had that, we had leverage, and we extracted, first of all, a great price, but second, a massive breakup fee from that buyer, and we even had them pay us half the breakup fee up front in a convertible note so that we had it in hand, and if the deal failed to close, then we had some protection and we could recover and hopefully get to a point where we could raise more capital. And you know and it was a real risky thing for us, because if you think about, you know, as a management team, if you actually decide now to take that exit versus growing your company, the message you're giving the investor community is, you know what, I'm not all that ambitious. I will take the first offer that comes along. It's a super negative signal for investors, especially growth stage Series B investors. So we were taking a lot of risk, but we had a lot of leverage because we were weeks away from closing funding. And we used that to completely just rip up the playbook and negotiate a very bespoke deal with lots of things that your advisors and VCs would tell you are never possible. I've seen the same thing on other deals, and literally anything is possible. So I guess the takeaway there is to always think through, what are your objectives? What do you need out of an outcome? What are your kind of, obviously your financial objectives, but what are your non-financial objectives? You know, what kind of role do you want to have in the company post-closing? And put all of that on the table so that you can have very robust discussions with potential buyers. I want to talk about buyer types, and this is a sweeping generalization, but you know what I've seen over the years is you can bifurcate the buyer market into 2 segments: founder-led companies and professional CEO-led companies. And those companies tend to have very different ways that they think about buying companies. So let's take Mark Zuckerberg from Facebook as the prototypical founder CEO. If he wants to buy something, it's a very top-down decision. It happens quickly. He doesn't need to get consensus. He can just make it happen. So when he bought Instagram for $1 billion, it's a perfect example of that. He was weeks away from going public. He paid $1 billion. Everyone at the time said, you're overpaying. It was an 18-person company at the time. But he just made it happen, and he had the authority, and it happened in no time, and there was almost no prior existing relationship between the companies. Contrast that now with IBM. IBM is one of the most acquisitive companies on the planet. Very large company. Their decisions, like their business cases to buy companies, happen from the ground up. You need to have joint customers, integrations, co-marketing. You need to have field sales reps who know your product and recommend your product to customers. There's just a very long and arduous path to getting bought by them. And I have worked on acquisitions with IBM over time. And I remember there was one time where they had more people from their corporate development team than we had staff in the company that we were looking to sell to them. It was just like a greater than one-to-one relationship. So think of like the ultimate bureaucratic process, and that's what you're dealing with some of these kind of very large, monolithic, professional CEO-led companies. And so I guess the point away, every situation is different, but I think really the takeaway there is to think about if it's founder-led, the path to an acquisition is absolutely getting that CEO, that founder, to have conviction about wanting to have you, because then they'll just do whatever it takes to make it happen. Whereas if it's professional CEO-led, it's a much more objective, much more kind of numerical, ROI-based business case. Drivers of deal value. We could probably do an entire talk on how you create premium value when it comes to selling your business, but this is just a few points to think about. Obviously, if you have alternatives, if you're bootstrapped, If you have lots of capital and you don't need to sell today, that's going to allow you to hold out for a higher price. If you're a compelling target and there's competitors who want you, that is going to drive value. Nothing is going to make a CEO want your company more than if that CEO's arch rival wants your company more. And because CEOs sometimes have very big egos. And so if you can appeal to that, great things can happen. That comes down to the next point, scarcity, right? If you are the number 12 CRM vendor, who gives a shit? No disrespect to anyone selling CRM. But if you have this really scarce product and, like Slack, I'm sure Microsoft would love to buy Slack. I'm sure, that's a pretty scarce product, pretty hot commodity. Who wouldn't want it? Mortal enemies. I've touched on this already, right? If your arch rival wants a company, you're going to want to buy it. If you're scaring the crap out of people, this was what was happening if I go back to that Instagram and Facebook example. Mark, I'm not on a first-name basis with Mark, but let's just call him Mark, looked at the growth in Instagram, and it scared the crap out of him. So out of nowhere, he just made a decision to buy it, and it turned out to be really good. If you're the market leader, that's really going to obviously drive value because you have a large company. But if you think about it, in any given market, there's a pie chart of value. And in most markets, most of the value will go to the leader in the market. There's a very big difference between the relative value that the first player is going to get to the second player. And after about the third player on, it's pretty long tail. And so many, many markets, again, especially in a business-to-business context, are buy or take most or buy or take all. And especially when you go up to kind of enterprise SaaS, there's just market standards that just get established, and then if you're a very large enterprise, you're always going to buy from that market leader. Clearly, if the CEO wants this, we've talked about that already, just kind of that ego, getting to the CEO and getting the CEO to want to do this and then just pushing that deal down, that impacts deal timing. It's going to happen way faster, and I think it impacts pricing. If it's on strategy, corporate development groups, those are the groups that are out there charged with executing acquisition activity. They're always out there kind of canvassing the market and seeing who's out there. But the deals that are going to happen are not just because you've built a nice little $2 million SaaS company that with their distribution could become a $20 million SaaS company. It's going to happen because you're filling a need that they have today, and they have determined that it is faster to fill that need by buying you versus building what you have. And so that comes back to this whole timing thing. Like, you have to be on strategy, you have to be there when they have a need, not afterwards. Currency matters. Lots of deals happen by selling or giving you shares of the buyer's company versus cash. This goes back to my earlier point and my concern around the fact that most of the European SaaS exits have been private to private, because then you're getting a currency that you can't buy food with. But it's much easier for me as a buyer to overpay if I'm giving shares. And time and timing, we've talked about that already. Timing in terms of whether you're on strategy and you're filling a need that I have as a buyer today, but also overall market timing. SaaS valuations went through a period about 3 quarters ago where they were cut in half. And so if you're a Workday or some other large public SaaS company and your price revenue multiple went from 10x to 5x in 2 quarters, you're not going to be feeling all that acquisitive, because if the markets recover, then you've suddenly bought a company paying for stock at the bottom of your cycle. And so thinking about where valuation trends are and how stable they are. As a public company, if you are always trading within a certain multiple range, that's going to give you the confidence to be willing to issue some paper to buy companies. Whereas if it's up and down, you're just not going to. Finally, I wouldn't be a good advisor if I didn't talk about the role of advisors. I think investment bankers have a very well-deserved mixed reputation, especially at that kind of lower snack bracket. I think the Goldman Sachs, the great bulge bracket firms of the world that do the really big exits, they are very credible. But in that kind of bread and butter sub $50 million exit, which is the vast majority of exits, you'll see a pretty wild cast of characters who have, there's no professional standards to become an investment banker. Anyone can hang out their shingle and say, yeah, I know how to sell your company. And they're pretty sketchy folks, and you kind of want to clean your hand after you shook their hand and all that jazz. But the bottom line is, I really do think you need an advisor when it comes to selling your company. There's so much that's written about raising capital for your business, and yet for many of us in the room, it remains a complete black art, and it's stressful and difficult. There's almost nothing written about how to sell your business. And when you're going through that for the first time, it's super emotional. You're picturing the yacht that you're going to buy when it's done. You're negotiating against your future boss. And it's really difficult, and these massive corporate development departments will descend upon you and look at every document you've ever signed. It's really difficult. And so having a really competent, credible advisor can really change the game. And even just the presence of that advisor can create a real or perceived threat of competition to the buyer, which keeps them honest. They can run the process for you. They can be there as your shrink, as you have the inevitable highs and lows. And so for all the reasons listed here, being able to good cop, bad cop, just make the deal happen faster, I strongly urge you, if you're going through an exit, retain some help, because it's really difficult to do alone. And in the same spirit earlier where I talked about how good things sometimes take time, I think the time to start building a relationship with an advisor is not when you have 3 months of runway left and you're like, oh shit, I better find a home for my company. Do it earlier, especially if that advisor is specialized in your space, because if they're worth anything, they'll start facilitating relationships with your buyers long before you're actually in an exit process. And so take the time to get to know those folks. That's all I have. Thank you so much.